What is going on, investors? Hopefully you guys are doing well out there. Time to talk about Netflix, which just reported earnings right now, right after the bell. And guess what? We printed a big, gigantic red candle after showing earnings and guidance that is somewhat disappointing to investors because this stock is off nearly 10%. In fact, right around 10%. Now, it fell right into a range right here that we've had marked out for a long time. If you're a fan of this channel, every Friday, we go over all the FANG stocks, including Netflix here and Tesla and Microsoft. And so we're constantly every Friday looking at the price action, picking out levels of support. This one's pulled back. I did not draw these lines in right now. These are lines that we have on the screen all the time, every Friday, and it's pulled back right into one. So the question you might be asking is this a buy the dip opportunity with Netflix? Let's talk about this. So the shares are sliding 10%. Over the last year, stocks up 31%, but year to date up only 2.5%, and that'll turn negative tomorrow if this after hours session continues. Now let's jump broadly into the numbers, and then we'll take a bigger deep dive into the regional breakdown, and then we'll get into kind of the overall metrics in terms of revenue and things of that nature. So first thing I want to show you is they have this Q2 21 forecast. Here's our Q1 right here. They give you a nice kind of quarter over quarter view. So here's like a year over year, and here's the next quarter's forecast. So on the revenue side, everything looks good. Okay, year over year, you're growing this thing 24%. Last quarter, we grew 21%. Previous quarter was 22. Obviously, when the height of the pandemic, we were still growing at 24, 27. It's pretty strong revenue growth, in my opinion. Now, operating income came in really strong, $1.9 billion. Next quarter, we're forecasting 1.8 billion and 18% revenue growth. So we're seeing a slowdown of revenue growth and operating income into Q2. So that could have investors a little bit worried as well. We're also seeing operating margins slip back to 25, but that is still higher than any of the previously 4 quarters. Q1 was particularly high with a 27% margin. That is pretty strong margins, obviously, for Netflix. Now, net income came in at $1.7 billion. That is way over anything that they've printed over the last few quarters, and it will be higher than the forecast of Q2, which is coming in right about $1.45 billion. Diluted EPS coming in at $3.75. Almost 3 times anything that they've printed here, and 316 is what they're forecasting in the next quarter. Now, I think this is what could have investors a little concerned here. So we've got global streaming paid memberships, okay? So this is just a global kind of running tabulation of the number of people that have a Netflix subscription, and we see that year-over-year growth slowed to 13.6. And notice it was kind of mid to high 20s for the last 4 quarters, and it is going to slip, they think, to 8% growth in the next quarter. So we're seeing a big time slowdown in terms of global paid memberships. That could be why this stock is heading downward in the after hours, because we're no longer in the year over year, quarter over quarter growth mode on paid memberships. And in fact, it might start flattening out. And so I think that what has some investors a little bit nervous. Let's take a look at the breakdown. We've got United States and Canada represented here as UCAN. So you've got revenue here. Again, revenue came in really nice, but essentially almost rounded off. We're basically flat, okay, the last 3 quarters. Paid memberships, same type of deal. We had that explosive growth in Q1 and Q2 of last year. Everybody was stuck at home. Everybody didn't have to go to work, those types of things, or lost their job. Heaven forbid. Sorry if that was you. But look, a lot of people were sitting at home and Netflix and chilling. Okay, not quite as much anymore. And we're seeing a flattening of that paid net additions. Now, here's what we've always talked about on our Friday show, is that the next leg of growth for Netflix is not going to come from these paid net additions, okay? With all the competition with Disney Plus, Peacock, Hulu, all the options you have to stream these days, net paid additions is probably not going to be the next leg of growth. It's going to be average revenue per membership. It's going to be them raising the price. And they were able to pass that along to the United States and Canada streaming services, okay, we actually see a 9% year-over-year growth on this average revenue per membership. How much can they raise this in the future? I think that's the question investors are asking, and maybe some are saying, well, they're not going to be able to raise price with Disney Plus, Hulu, all these other services in the marketplace. They might not be able to raise this. So that's a question that people might have to ask. Also, will Netflix have to pivot to another model? Okay, if they can't keep raising the price on their subscription, well, maybe they introduce advertising like a Roku or a Hulu or something like that. Be interesting to see. Now, let's take a look at EMA. I believe that's Europe. We're seeing here we have paid memberships here and we have paid net additions here. We're seeing a big acceleration in Q4, but back to kind of a slow, I wouldn't say a slowdown, but a little more reversion back to the mean here at 1.8 million net additions on the Europe side. Revenue growth is still coming in strong. And why is that? Average revenue per membership up 11% year over year, $11.56 compared to $10.40 a year prior. So they're driving more revenue to this top line by raising the price, but in some cases, that could be slowing net paid additions. And so there's a push-pull there. Obviously, you raise the price too much, people will cancel, or they'll rather have another subscription that costs less. So we'll see if this is something that Netflix can maintain in future quarters. Investors obviously have to weigh these types of things. Next, let's take a look at Latin America right here. We've seen revenue basically flat. Okay, it's up a little bit over the last year or so, but it's basically in that high 8 to mid 8. I mean, it ticked up nicely to 837 in the most recent quarter. We've got our paid net additions right here. We're seeing that just screech to a halt, especially in this most recent quarter, okay? Only 0.36 net additions. Now, here's the worrisome thing in this market is you've got year-over-year growth on average revenue per membership. It actually is down 8%. Membership was paying $8.05. Now they're paying $7.39. So whatever it is about the Latin America market, they were a little more price sensitive than the Europe and the United States market, and they were not able to pass along any price increases. In fact, they had to decrease the price for Netflix. And you see, even with a decrease, an 8% decrease, they didn't really add a bunch of people, at least in the Latin America. Now, finally, another key market is this Asia Pacific. We're seeing revenue tick up nicely. Okay, last year you were at 44. Now you're at 762. That's strong. We see paid net additions actually have slowed down considerably. Okay, we were at 3.6, 2.6, down to 1, back up to 2, back to 136. Not bad, okay? And then we've got this year-over-year growth on our average paid membership, 9%. So they are able to pass along some price increases to that group of Netflix watchers. Now, from a high-level view, we'll take a look at revenues and things like that, and then we'll get back over to the stock chart. We'll talk about where this one is trading. So we've got our revenues here. We've got our 3 months ended here. We've got December over March, so basically quarter over quarter here, and this is March of last year. So we've got a year-over-year view. Look, revenues have grown tremendously, $7.1 billion versus $5.7. In the previous quarter, we were at $6.6. Cost of revenue coming in at 3.8. Look at this. It's actually lower than the previous quarter where we had lower revenue. And take a look, our revenue's up quite a bit, I'll call that about $1.4 billion over the last year. And our cost of revenue is almost identical, okay? Almost a rounding error identical. Also, marketing down. Technology and development, just basically flat, and general administrative also flat. That gives us operating income of ba-boom, $1.9 billion. That's a billion. Yes, $1 billion more than where we were at in the previous quarter, and $1 billion more than the previous year as well. Now, obviously, Netflix has kind of put a halt on some production, some filmmaking, some, media buys, things like that, or show buys, things like that. So we've had some of that maybe pushed aside, some of these costs not necessarily reoccurring. They're going to have to maybe step that up, especially as competition and things of that nature get into that. Now we've got some interest expense, interest in other income. We've got our income before our income taxes came in at $2 billion. We were only at 500 million and 800 million in the previous periods here. Boy, it was a fantastic quarter in terms of earnings. And so again, it's one of those things. As an investor, you might be confused. Well, why is Netflix trading off 10% in the after hours after printing these numbers where they have net income of $1.7 billion? That's $1.2 billion over where we were last quarter. And that's over $1 billion, or almost exactly $1 billion more than where we were at last year when Netflix was soaring high. Well, obviously, investors don't care about net income when it comes to Netflix, okay? Because if they did, this stock would be going up 10% because it's a fantastic quarter in terms of revenue, controlling cost, and flowing that revenue to the bottom line. Investors want growth. They want membership growth. They want explosive stuff. Netflix is going to have to put it into another gear, in my opinion. They're going to have to come up with something new, just like when they shifted. Some of you younger viewers of this might not remember, Netflix was a CD delivery. You would order CDs, they would send you the CDs, you'd watch them, or DVDs in this case. You'd put the DVDs in your DVD player, watch the movie, and send it back. Okay, almost like a mail order. And then they switched to streaming. I'm not saying that they have to pivot their business model that hard or do something that drastic, but they're probably going to have to do something a little bit different because investors are not loving what they're seeing here in terms of growth any longer. We've got net assets basically flat, everything looking consistent here on the balance sheet from a liabilities perspective. You got a little bit of debt here. You got a little bit of long-term debt. I don't mind that. They have to finance a lot of shows. They have to put forward a lot. Think about you to make a movie, you've got to, or any series of shows like they tend to do on Netflix where it's 10, 15 shows all in a row. Man, you got to put a bunch of money down before you get any of that money back. So they have to have debt. They have to finance some of this stuff. I don't got any problem with that. Now, from a cash flow perspective, as you'd guess, when you print $1.7 billion to the net income side, and that's like over $1 billion what you've done over the last period, guess what? Your cash flows are going to be absolutely phenomenal. At $777 million, we were actually a negative cash flow in December, and we were only at $260 in March when things were actually going pretty well for Netflix. So those are the financials. Let's get over to the stock chart now and take a look at this one again. We're printing a minus 11% on Netflix in the after hours. We were way up here at in the 550 range. We're all the way down here at $500. All these lines, all these horizontal lines, if you're not familiar with the channel, we draw these on every Friday. In fact, they stay the same. These have stayed the same for a very long period of time for our Netflix analysis because this is where buyers step in and this is where sellers step in with Netflix. And it's not at all surprising right at this $490 range. This is where buyers have stepped in with Netflix over the last, this is the last 3 or 4 months. This is December right here. The stock rallied, came back down to $490, buyer stepped in. Then it gapped way up to $600. Could have been on earnings, came all the way back down to $490, went all the way back up to $565. Now here we are again at $590. So if you like Netflix, you have it in your portfolio already, you've wanted to add this one. In my opinion, this is a spot where you could potentially add Netflix. Would I go really hard on this one? Not necessarily, but I think on a scale of 1 to 10, say I wanted, here's a better way to put it. Say I wanted 10 shares of Netflix, which would be about $5,000 at today's price. Say I wanted 10 shares of it. At these levels, I think I'd be a 2 to 3 share kind of a person to buy. Now, if you're not familiar with the channel, I like to inch into things. I know there's some people that like to go all in, all out. Those investors don't typically have a lot of success, in my opinion. This is an area where I'd like 2 or 3 shares, wait a couple days, because we've broken this 490 level. Notice what's happened when we've broken this 490 level. What has happened? We've come all the way down here to $470. You come down to 470. That's where I'd like to add probably 3, 4, maybe even 5 shares of Netflix down in here. I'd like to get my 10 shares between 470 and $4.90 in this one, because as you've seen for the last, this goes back to the summertime of last year, June, July of last year, this stock has bottomed at $4.70 and has rallied as high as $5.90 and has come back and forth. So however you want to play this one, I think there's an opportunity here. I'm going to be watching this one closely as we head into tomorrow and the rest of the week. This is not a stock I currently own, but it is potentially one I will add very, very small amounts at these levels, because this has triggered, this is a buying opportunity, in my opinion, for Netflix. If you believe that the company will continue to evolve, okay, I truly believe this is a company that's going to need to continue to evolve. I don't think they have enough pricing power here with all the competition from Disney, NBC, ABC, all those types of brands out there, media giants. There's just not enough eyeballs and hours in the day to watch enough Netflix. They're going to have to introduce an advertising model. They're going to have to start experimenting with other ways to make money, in my opinion. And Netflix has proven they've been able to do that in the past. Wouldn't surprise me if they do it again in the future. So that was Netflix. Let me know down in the comments what you think about this one. Boy, it's rare you see big 11% down draws on these biggest stocks. And when you do, typically is a buying opportunity. So that was Netflix. Hopefully you guys enjoyed that one. Good luck with your investments.